Uber was down around 10% in the market yesterday, giving us a great opportunity to buy the dip on this growth company. Now, it is currently trading towards its 52-week lows, and we're going to run through why we like this company, the growth prospects, as well as looking at the valuation, why we see a lot of upside and a nice margin of safety. But to begin, we need to understand why this company was down significantly yesterday. And we did receive news that Waymo, that is the Alphabet-owned Robotaxi service, is expanding into Miami, and you will be able to use their services from 2026. Now, they have been rapidly expanded over the last few years, and this is good news if you are a shareholder for Alphabet. But why has this essentially affected Uber? Two different companies, and what we can see, an analyst has mentioned that this is laying the groundwork to eventually completely cut out Uber. Now, what is it meant by this? Well, for those that don't know, just in September, we saw that Uber and Waymo announced a partnership in which they would be bringing autonomous rides to Austin as well as Atlanta, and you would need to go for this service through the Uber app, essentially using the network that Uber does have with their fleet. Now, for Miami, Waymo actually didn't go with Uber. We can see here they have identified another partner, and the market does believe that this could be the first stages of Waymo cutting out Uber, and in fact, over the longer term, wiping out this company completely. Now, the analysts don't believe this is a sell. What they are essentially saying is that if Uber can leverage their dominant ride-hailing network in the period of autonomy that we are now entering to, then this could be a great opportunity to buy. However, you do need to consider the flip side, which is that this company may be disrupted by autonomy. So quite a lot to consider with Uber. It may look very strong. The growth metrics are very good that we will come to show you, as well as the valuation. That you also need to think about whether you see this company eventually being wiped off due to autonomous vehicles that we have seen, not just from Waymo, but also anticipated from Tesla as well. And this is just what we wanted to highlight in terms of the partnership. Uber will be offering these ride-hailing trips with Waymo in a few different states. That will be beginning early next year. So let's just take a quick look at their performance. Now, year to date, they are up, although very marginally, at 6%. Over the last 12 months, up around 12.5%. And over the last 5 years, you would have outperformed the S&P 500. They're up 128%. Now, we've mentioned they are trading towards their 52-week lows. In fact, the 52-week low is around $55. We get a double buy rating from Seeking Alpha and Wall Street. But do note one thing, a buy from Wall Street at 4.44 isn't too far off what would flip this to a strong buy at 4.5. And whilst Quant, again, giving this a hold, 3.44, not far off them flipping this to a buy rating. In terms of the forward PE, it sits at just under 35. We'll look at their projections over the next few years now as well, just to gauge where they do see this over the next full accounting period. In terms of moving forwards, a little bit of inconsistency over the next 4 quarters, and when we do look at the last 4, they actually beat 3 of them. The more recent 2 we can see fairly sizable, giving them a 75% track record, 3 out of 4. And if you do have faith in management and their projections, well, over the next full year, that is December 2025, if they hit the 231 earnings per share estimate, the forward PE will be lowered down to 28.24. Now, how did they perform in that latest earnings? As we saw, some very sizable beats. Well, as the headline does suggest, they did perform very, very strongly, beating what Wall Street were expecting for the company, and their top line grew in comparison to the same quarter last year at a rate of 20%. In terms of the earnings per share, well, it was incredibly strong, $1.20. The market was anticipating 41 cents, and the revenue 11.19. The market was hoping for around 10.98, so very good performance across both metrics. As we mentioned, their revenue also up around 20%, and their bottom line bringing in $2.6 billion. That is up around $221 million from the same quarter last year. Now, what about their underlying metrics? Well, their free cash flow per share, what we typically want to see are consistent increases over the longer term. And whilst we do get it negative from 2016 to 2021, we do get here improved performance every single year, and that trend has continued into 2022, where we see it free cash flow positive for the first time, and anticipated to pretty much double over the next 12 months to $3.37, definitely looking very good. This is typically what we want to identify from companies where they are essentially at the growth phase. They're moving from negative metrics towards positive, and this is typically where we do get to see a large portion of those very extreme gains. In terms of sales growth, well, nearly double digit every single year bar 2020. No surprises, we had the lockdown. 17% in 2023. Based on that quarter that we just saw of 20%, we do anticipate another double digit year for Uber. And then from a numerical perspective, we can see just over the last 8 years, they have pretty much increased their top line tenfold. Massive jump anticipated into 2024 based on the trailing 12 month. Now, we don't like to see this. This essentially shows us that management have diluted your position as a shareholder over the longer term. The one thing we would say though is if over the longer term they can continue to outperform the S&P, then you probably wouldn't be massively fussed by this share dilution, but definitely something to keep an eye on. ROIC, we want to see 10% or more. Give us faith, management are able to effectively allocate their capital. What we can see, negative for a vast majority of time, indicating only recently they have turned a profit. We'll show you that from the financial statements. 5% in 2023, 9% on a trailing 12 month. We really do want to see this consistently start to move upwards and have a 10% at the very minimum level. We then move on to the operating margin. Again, mirroring what we said earlier, they haven't been able to turn a profit for that many years. In fact, 3% in 23, 6% on a trailing 12 month. And the same to be said for the free cash flow margin, although here we typically want to see a minimum of 5%, something we have seen in 2023, and the trailing 12 month looking very positive. In terms of the net debt to EBITDA, the earnings before the interest, tax, depreciation, amortization, we want to see below 3. These are the number of years it would take the company to pay off all of their debt net of cash on hand, and it does correlate to the balance sheet strength. 0.66 on a trailing 12 month, looking very, very strong. We'll come to show you as well. Balance sheet does look healthy. 0.5 over the next 12 months, signaling that is the direction they're moving to delever the balance sheet, paying off debt, which is good news for shareholders overall. We also want to highlight a few slides from their latest investor presentation, and what this shows us, if you want to look at the constant currency growth, every single quarter they have been increasing at double digit. In fact, that also applies if you look at the growth year on year, plus 20%, looking very strong. And if they can maintain this, this will continue that message that this is a growth company, and their earnings per share, as we will come to show you, is anticipated to grow more than 40% over the next 5 years, and that is on a yearly basis. In terms of their revenue, very, very similar to what we just mentioned, not only their gross bookings, but also reflected in their top line, plus 22%. That is just from the more recent quarter. In fact, it has been steadily increasing just over the last 5. Then we get to the adjusted EBITDA, the same message to be said, not only increasing, which is always what we want to see, but also the EBITDA margin moving in the right direction, which is very important to us on this channel. We don't just want to see growth in the typical numbers like the revenue, like the margins, but we also want to see improvements here across their margins as well. That is what we identify as a high quality company. And something just interesting to note for maybe those that weren't aware, they do also own some equity in some of these companies that you may have heard of. Now, before we do continue, just to let you know, we have released our latest free weekly article where we run through 2 cheap stocks that have gone under the radar. Now, we release one every single Monday morning to your inbox where we highlight severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up, read straight away. You'll also be able to gain access to 28 undervalued dividend stocks for the month of December. Lots of information as well as the upside that Wall Street themselves see over the next year. And on top of that, a recently released spreadsheet that targets 29 undervalued stocks that Wall Street themselves believe have the most upside right now in the S&P 500. So click below, you can sign up and start reading straight away. We also look at the insider ownership, which sits at just under 4%, with around 86 million worth of sales by these insiders over the last year. In the most recent quarter, Q4, we see around 2 million worth of sales. For those that do want to see, the most recent one being on the 25th of November, so just a few weeks ago, they sold around 28,000 shares, netting them $2 million. Now, our view, insider selling, not necessarily a bearish signal. They sell for many reasons, personal and financial, but information is here if you do want to use it as part of your overall investment thesis. Institutional ownership around 80%, where we see 10.4 billion worth of sales over the last year. In the same time frame, we actually get more buying by the institutions, around 6 billion worth, and we also notice over the last 4 quarters and all of 2024 and in the more recent quarter, Q3, institutions have been buying more than they have been selling. So they are fairly bullish on this company, but as always, don't copy what the institutions or insiders do blindly, and always do your own due diligence. Now, we've already highlighted their top line revenue, some very strong growth just over the last few years, but what we want to identify here is what is the story that is being told on the bottom line net income, and something we already alluded to earlier, they haven't had many years where they have turned a profit. In fact, 2023 is the second year over the last few, and what we also identify here is that whilst it has been inconsistent in the bottom line, that on a trailing 12 month, indicating to us that 2024 is going to be a very strong year, in fact more than double what we did see in the previous 2023 report. So that is good news. And then we show you the balance sheet, a quick health check, total cash versus total debt. What we notice over the longer term, cash has been very inconsistent, although it has increased from 6.3 billion in 2016 to 9.1 just from that latest Q3 earnings. But do remember, one number here in isolation won't give any information away, which is why we do compare it numerically and directionally to their total debt, which as we can see has been increasing over the longer term, going from around 3 billion in 2016 to 13 in the latest quarter. Now, that isn't too far off the cash balance, and as we saw, the net debt to EBITDA is below 1, so the balance sheet overall at a quick glance does look to be healthy. We then want to highlight the cash flow, more specifically, what is the cash this company is generating from their operations, and as we have seen throughout, they haven't had the best history over the longer term in terms of bringing out a profit, and that is also shown through their cash generated, but nice to see the last 2 years they have been positive, 3.6 billion in the latest annual accounts. On a trailing 12 month, again, we are seeing this company rapidly improve from the historical numbers that maybe weren't something to be very impressed about. Then we want to look at some gradings. The first one is the valuation, where it gets a B-. In terms of a P on a non-GAAP basis at 26.3, we do in fact notice it is higher than the sector median of 21.2. There in turn meaning if you are buying this company right now, you are paying a 23.5% premium. Is it demanding of such a premium? Again, something to consider. We will run it through our margin of safety as well. But we do notice on other valuation metrics, for the large part, this company does trade at a substantial premium. We then move on to the growth grade, where they get an A+, indicating to us they do deserve a premium of some sort. Revenue growth year on year, 17%, better than the sector at 4%. Revenue growth moving forwards, 17%, better than the sector median of 5.6. And the main thing we wanted to discuss and highlight earlier on, the earnings per share anticipated for this company over the next 3 to 5 years is 41%, when the sector median sits at 11.6. We then move on to the profitability, where they get an A+. Gross profit margin, 33%. That is pretty much in line with the sector at around 32%. Bottom line, 10.5. It is a little bit better than the sector at 6.5, but one thing that makes this company stand out is the cash from operations over the last 12 months, 6.21 billion versus the sector of 350 million. Now, a quick recap, they get a double buy signal with a hold from Quant. Remember, Wall Street not far from flipping to a strong buy, Quant not far from flipping to a buy, valuation B-, growth A+, profitability A+. 2 more things before we jump into the actual valuation itself, comparing this company against others in the similar industry. And when we look at their return over the last 12 months, they're up only around 12.5%, pretty much sitting in the mid-performance of these others, although bearing in mind they did just drop around 10% yesterday. And over the last 5 years, we can see they're up 128%, which is fairly decent, but remember the past performance doesn't give us any indication to the future. And whilst we'll compare it to the S&P, we can see over the last year, S&P has outperformed. When we look over the last 5 years, Uber has outperformed. So really depends how much faith you have in this company over the longer term, especially with some of the bearish considerations about whether or not autonomous vehicles will wipe out this company over the long period, or in fact, if you do believe they can leverage their network, in fact with partnerships like Waymo, possibly with Tesla into the future, to really help kickstart this company into some massive growth over the longer term. Now let's jump into our valuation model. As always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now our intrinsic value of $93, we've derived this from the DCF model, and when we take a look, you can see we have the free cash flow year on year. Average growth 88% over the last few years. We've gone for 12% moving forwards, as you can see, a low, medium and high rate. With a discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as you can see, $93 indicating around 41% upside. Remember though, these numbers are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether or not it is for Uber or any others that you do desire. Full transparency will show you at the 10% rate, intrinsically $82, 24% upside, and at 14, for those that are a lot more optimistic, $106, indicating 60%. So we'll take through 12%, and what we always do on this channel is apply a margin of safety, 10%, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If we believe that in today's episode, a buy at $84, then we keep going till it's near the current trading price, and what we can see in today's episode, around the $65, $66 mark, this is giving you a 30% MOS, and Wall Street, as we said, not far off a strong buy rating. They see 45% upside over the next year. Their price forecast, $96. As always, give us your thoughts. Maybe for you, the bearish catalyst outweigh the bullish. Maybe the valuation looks very good, or in fact, this is purely just a hold. If value was provided, smash that like button, hit that subscribe and bell button. Don't forget to sign up to the free weekly newsletter below. Grab those spreadsheets, and also come and join us in the Patreon, where we do talk about our weekly buys and sells. As always, have a great day, and we'll see you all on the next one.